Common mistakes to avoid in Forex trading. Forex trading can be a rewarding endeavor, but it also comes with its fair share of risks. To increase your chances of success in the Forex market, it's important to be aware of common mistakes that traders often make and take steps to avoid them. Here are some common mistakes to avoid in Forex trading. Lack of education and preparation. One of the biggest mistakes beginners make is diving into Forex trading without sufficient education and preparation. Forex trading requires a solid understanding of market dynamics, trading strategies, risk management techniques, and technical and fundamental analysis. Take the time to educate yourself through books, online courses, webinars, and practice on demo accounts before risking real money in the live markets. Failure to develop a trading plan. Trading without a well-defined trading plan is a recipe for disaster. A trading plan outlines your trading goals, strategies, risk management rules, and criteria for entering and exiting trades. Without a plan, you may fall victim to impulsive and emotional decisions, leading to inconsistent results. Develop a trading plan and stick to it to maintain discipline and consistency in your trading approach. Overtrading. Overtrading is a common mistake where traders excessively enter and exit trades, often driven by emotions or the desire to make quick profits. Overtrading can lead to poor decision-making, increased transaction costs, and unnecessary exposure to risk. Focus on quality trades that align with your trading strategy rather than trying to be constantly active in the market. Ignoring risk management. Failure to implement proper risk management is a grave mistake in Forex trading. Risk management techniques, such as setting stop-loss orders, position sizing, and diversification, are essential for protecting your trading capital. Ignoring risk management can expose you to significant losses that can be difficult to recover from. Always prioritize risk management and adhere to your predetermined risk parameters. Chasing losses or revenge trading. Chasing losses is a dangerous psychological trap that many traders fall into. It occurs when a trader tries to recover losses by taking on excessive risks or deviating from their trading plan. Similarly, revenge trading is when a trader seeks revenge on the market after a losing trade by taking impulsive and emotionally driven trades. Both of these behaviors can lead to further losses and damage your trading account. Accept losses as part of the trading process and avoid making impulsive decisions based on emotions. Lack of patience and discipline. Patience and discipline are critical qualities for successful trading. Impatience can lead to entering trades prematurely or exiting trades too early, missing out on potential profits. Lack of discipline can result in deviating from your trading plan or taking trades that don't meet your criteria. Cultivate patience and discipline by sticking to your trading plan, waiting for high-probability setups, and avoiding impulsive decisions based on emotions or market noise. Following the herd mentality. In Forex trading, it's common for traders to fall into the trap of following the herd mentality. This occurs when traders blindly follow the crowd or rely heavily on the opinions of others without conducting their own analysis. Remember that the Forex market is influenced by various factors, and blindly following others can lead to poor decision-making. Conduct your own analysis, develop your own trading strategy, and make informed decisions based on your own research. Neglecting emotional control. Emotional control is a crucial aspect of Forex trading. Allowing emotions such as fear, greed, or excitement to drive your trading decisions can lead to irrational choices and poor outcomes. Develop emotional self-awareness, practice techniques such as deep breathing or meditation to manage emotions, and stick to your trading plan to minimize the impact of emotions on your trading performance. Conclusion. Avoiding common mistakes in Forex trading is vital for long-term success. By educating yourself, developing a trading plan, implementing proper risk management, exercising patience and discipline, avoiding impulsive and emotional decisions, conducting your own analysis, and maintaining emotional control, you can increase your chances of profitability in the Forex market. Remember, trading requires continuous learning and improvement, so stay vigilant and be willing to adapt your approach as needed.